Welcome to Season 2 of the SOAR podcast, the place for creative entrepreneurs who want to build healthier, happier, more profitable self-employed businesses. I'm your host, Ray Hyde Cornell, business mentor at Chiron Consulting and CEO and senior copywriter at Cornell Content Marketing. Get ready to soar. Welcome to the SOAR podcast. Today, we have an old friend of mine who is insanely knowledgeable about all things finances and business structure and all those kind of unsexy but sexy things that you have to have in your business. Katelyn Magnuson. Katelyn, introduce us to your business. Tell us about what you do.
Hey. I run the Freelance CFO. We're a full service accounting, bookkeeping, and tax prep firm that empowers you and your business to achieve your own version of success by removing barriers and customizing our approach to meet you where you're at, to get you where you're going. And what that's a really lovely way of saying is that we are here to drop the shame game. And I know that I've experienced it, and a lot of our clients have experienced the shame that comes along with finances, with accounting, with money, whether that's where you're at, the money that you have, the mistakes that you've made, or the knowledge that you do or don't have. And so that's really what we aim to correct in how we're approaching finances and money, because it can be a really scary topic.
Yeah. And that's the thing, right? Is like anytime we talk about money or we talk about taxes, which I tell my tax guy this all the time because, and bless his heart, he has so much patience with me, but I'm like, I just have a mental block around taxes. I consider myself pretty smart. Like I can figure out most things, but I get into the tax arena and my mind is just like, what the fuck? Like I can't compute. I don't understand any of this. And so it's so fantastic that freelancers have a resource like you because you make sense of all of that craziness for them. And one of the things that I really want to get into today is this very foundational decision and something that we always have to kind of have in the back of our minds as we go through business, we grow, we build, we scale, which is your business formation and the type of entity that you're creating. So I want to kind of demystify that for people because that's really the starting point of everything that comes after in terms of your taxes, your liability, your financial planning, all of that. So let's dive into that. Tell me about the three main options for freelancers and self-employed creatives that we need to kind of demystify.
Absolutely. So the three main ones, and these kind of, the last one is kind of one and a half, but you have sole proprietorships, you have single member LLCs, and you have S Corps. And S Corps aren't actually an entity, they're a taxation election. And what that's a really fancy way of saying is that you can be an LLC with an S Corp election. You can be a corporation with an S Corp election. The S Corp election is just you telling the IRS, hey, I'm this type of entity, but I want to be taxed this way. And so that's what it means. But an S Corp is not an entity type, but it is really common for tax savings. So you'll hear people kind of throw it around. Now, a sole proprietorship and a single member LLC are what are known as disregarded entities. And so if you've filled out a W-9 ever and you're looking at the top and it has all of these different options, right? It has sole proprietor, single member LLC / disregarded entity. That's exactly what it's talking about. Basically, your business is established and you've said, hey, I have this thing that I'm doing that I love, hopefully. And with that, the business is there and it's established, but there's no tax liability that the business itself has for income taxes. You may have sales tax or excise tax. We're not talking about that. This is income taxes. So when you think of like a corporation, like Apple or something that is paying taxes on their income as a company, disregarded entities don't have that.
So is that basically like the IRS sees, when you say disregarded entity, my mind thinks, okay, so the IRS is basically going to see my business as the same thing as me. Like we're one and the same. Do I have that right?
Very close. Yes.
Okay.
So basically everything from your business funnels into your personal. So the entity is there, but think of it as like a bucket with a hole. All of the profit, everything that comes from that drips into your personal return.
Mhm.
And it's all done in one return together. So if you're a freelancer and like, let's say you use TurboTax or, Free Tax Act or something to file and you have business income, you might be a little bit surprised because you might be like, well, yeah, but I didn't have like a separate business return. You don't. Disregarded entities mean that like you do all of your filings together. And if
Okay.
you look really closely at your tax returns, you actually have a couple of additional forms or schedules in there that have your business information. And what
Mhm.
happens is the remaining profit from your business or loss, especially in those first few years, passes into your personal return.
Mm.
And then you pay income taxes or not, if you've had a loss,
Mhm.
based on that overall profit. Your business doesn't technically pay anything, which is really kind of muddy when you think about it.
Yeah. Yeah. Okay. So that makes sense for the sole proprietorship and the LLC. Now, is that once you do an S Corp election, which by the way, I'm so glad that you you clarified that because I've been wondering that for a while because I went S Corp a few years ago, maybe 5 years ago, but my business name still has the LLC at the end of it. And I'm like, oh, do I need to fix that? Like, oh, did I do something wrong? But what you're saying is no, actually, you're both at the same time. But with the
Yes.
S Corp election, that's not a disregarded entity, correct?
Correct. So once you, and I'm going to say this, and it's not meant to be patronizing in the slightest, but that's kind of when you really step up your game or like, put your big
Yeah,
girl pants on.
yeah.
When you go into that next step, that's when, okay, we've now communicated to the IRS and the state that I am a business. I am
Mhm.
filing a business return. There are some benefits that come with being an S Corp, but you have, in some states, you'll actually have some business taxes. Like
Mhm.
California is really notorious for this, right? The $800 that you may see thrown around everywhere. It's not actually just $800. It varies depending on what you're making. But that's an example of a business level franchise tax.
Mhm.
You'll see that in a few other states, like Illinois has one, Louisiana has one, but normally they're relatively nominal. You're looking at like less than 1% of sales, and that sales or profit, depending on the state, and that still comes out dramatically ahead normally
Mhm.
of your tax savings amount. So you're still saving more. There wouldn't be a point to convert to having an S Corp election if you were not going to have a tax savings. That is the entire purpose of the S Corp election. So
Got it.
for a
Okay.
lot of people, and I'm going to walk through kind of the path that I recommend after this, but for a lot of people, they may dive right into an S Corp election
Mhm.
right off the bat. And they're like, yep, I'm an LLC with an S Corp election. But if you don't have the income to support that, you're going to be spending some more money. You're going to be putting things in place that, by all means, if you grow really rapidly, you'll be so set up for success. But it's kind of jumping the gun a little bit there.
Yeah.
So you want to start with smaller, less expensive baby steps and then plan on rolling into an S Corp election. But what you brought up is so common because even now our clients will ask me, hey, I know I'm an S Corp. You're not an S Corp. You have an S Corp election because
Mm.
they'll go to fill out a W-9 or they'll, like all the PPP funding or anything that was coming through. They have to say like what their organization type is. And
Yeah.
they're like, yeah, I'm an LLC, but I'm not. I'm like, no, you are. For all
Yeah.
things legal, you're an LLC.
And that's never going to go
Strictly for
away.
taxes. Yeah, that does not go away.
Yeah.
Strictly for taxes, you have an S Corp election because no one else really needs to know. It's on your tax return, it impacts your payroll, and it impacts your W-9. And that's generally it.
Oh, that's huge. Okay. And so
Yes.
you just made me realize I think I checked the wrong box. I think I checked the S Corp box on some of
Oh,
these
see, and if you check
forms.
the LLC box, and that's anyone that's listening, if you're filling out your W-9, you don't check the first LLC box with that disregarded entity. You check the second one. And then on the far right-hand side, you write in a little S. It says C, P, or S for
Ah.
corporation, partnership, or S Corp. And that's where you'd fill it out.
Oh, goodness gracious. I've been doing this 15 years and now I'm finding out I've been doing all this
You
tax
got a
shit all
whole laundry
wrong.
list of things to correct. Yeah. No, and that's
Okay.
that's a really common one. And same thing, if you're a corporation with an S Corp election, that would be the same case. You'd mark corporation tax as an S Corp. And that's because it makes a
Interesting.
difference. S Corps don't have to, if you were to send me a W-9 that showed
Mhm.
you were an S Corp, I wouldn't need to issue you a 1099. And that's just like a funky little thing that we don't have to get into. You can also choose to disregard it as an S Corp then.
I
And the
see.
IRS in their infinite wisdom does this because they think there's more transparency since you're now filing a separate business return,
Mhm.
even though we've been reporting all of that same info
Right.
in your personal return. It's just because you've legitimized your business, it
Mhm.
comes with kind of, I'm going to say some perks there. Like you're still responsible for claiming your income, but it makes things a little bit simpler on that side of the paperwork.
Yeah. Okay. So before we dive into the like when you should be which of these three designations, I want to talk about that little like shadowy figure in the corner, just so we can get that out of the way and people aren't, confused between the two when they fill out these forms. C Corps. C Corps are one of these things, and we were talking before we started recording about how it's kind of like, this is my judgment of it, and I want to hear your opinion here. C Corps are one of those things that are not really relevant to us as freelancers and self-employed entrepreneurs. It's kind of a vanity thing that can actually get your finances super fucked up if you choose that path down the road. Do I have that one right at least?
Say absolutely.
Okay.
So C Corps to me, whether they're vanity or not, I've seen some where I think they're vanity, and I've seen some where I think maybe someone was a little bit more optimistic
Mm,
than they should have been, or maybe this is notorious, they heard about it on TikTok,
yeah.
or like TikTok is wonderful, right? I love TikTok, but it's also rife with misinformation or information that's not actually applicable to you and your individual situation.
Yeah.
And C Corps make accountants more money.
Mm,
So there's also like an ethics side of it because there's more filings that go along with it.
mm,
So making sure that you really understand, like C Corps, you have to have quarterly filings. It's expected that you have payroll. It's expected that you have, it is for everyone listening. I'm going to say I can almost guarantee that a C Corp is not applicable to you. You can be making, and as we were talking about beforehand, I recently had a client that sold her business and she was actually on track to make 6 million this year. She was an LLC with an S Corp election. And that was by far the best taxation choice for her and her business because she was the sole owner. She was one of, I think, 8 employees. And with the way everything shook out, it made the most sense. C Corps come with a lot of extra red tape, expenses, and returns that are not required. And I think, frankly, really get us in over our heads because like that other client we talked about, they didn't have any idea that they needed to be doing quarterly filings. Someone just said, hey, you should set up as the C Corp in Wyoming when they don't live in Wyoming, because that was going to be great for taxes. And then at the end of the year, he's like, oh, I'm getting all these notices from the IRS. Like, yeah, man, because you have filings that you have to be doing that you didn't know
yeah.
about, that cost money, that take time, that like really aren't right for the stage of business for you.
Yeah. Yeah. Okay. So unless you are Apple or Apple adjacent, don't worry about C Corps. That's why we're focusing on talking about sole proprietorship, LLC, and S Corp. Now, as we go through this, and you mentioned there's a pathway that you recommend that people kind of progress through. Let me tell you kind of like my understanding, and then you can tell me if I'm totally way
Perfect.
off and wrong on this as well, because you're correcting a lot of my misconceptions along the way. And I think a lot of people who've been kind of just like, oh, I'm good at writing or I'm good at design, I'm going to jump in, I'm going to do this business thing. And this is kind of the afterthought. I think they have the same misconceptions that I have. So the way that I've always looked at sole proprietorship is that's when you are just like, you're kind of dabbling, you're doing things under the table. Maybe people are sending you a little bit of money on PayPal. Maybe you're even getting some cash or like check payments from local businesses. Like you are super ground level and you can kind of stay that way as a sole proprietorship. LLC then is kind of when you start taking your business seriously, but you're not yet making enough for an S Corp to make sense financially, because there are more expenses that go into doing S Corp filings. And at some point, once you tip over that threshold, an S Corp can actually save you money in tax liability. But until you get to that point, you're going to be in that LLC territory. And so if we were looking at this in kind of like a bell curve sort of way, I think very few people end up in the sole proprietorship arena. And then I don't want to say very few, but a lot more people will hang out in that LLC area until they get past a certain financial income threshold. That's the extent of my knowledge, or
I'm going to say that you're like
understanding.
90% of the way there.
Awesome. Okay.
As
Fill
like a
me in.
really good overview. Yeah, that was solid. I am going to throw in like one caveat here. The second you are making money in your business, you're responsible for claiming that on your tax returns. Does that always happen? No. But as a sole proprietor, you can either choose to register in your state or not. And what I mean by that is if you're operating under your name, you don't necessarily have to register. If you're operating under a business name or an assumed business name, you need to have at least that set up so that you can basically do business as that in the state.
Yeah. And
You don't
here
have to
in
have anything
Texas,
set up federally.
they
Yeah,
call
it's
that a
simple.
DBA, and you have to go down to the
Yeah, a
courthouse, you sign the
DBA.
DBA.
Yeah, which is doing business as, or an ABN in some states, assumed
Okay.
business name. It's all the same. There's a couple of other ones that I'm not thinking of right now, but every state kind of has their own distinction for it. And it's simple. It's easy. It's normally free or very low cost. Like we're talking normally $15 to $25 a year, very nominal. That you can also set up an EIN with that entity type. And the reason that some people would do that is because it keeps you from having to hand your social security number out all the time. It gives
So
you an
sole
EIN.
proprietors, they have to use their social security number, but LLC gets an EIN.
LLC has to have an EIN, which is
I
a
see.
really common misconception because a lot of people that start out as a sole proprietor didn't have to have an EIN. The good news is EINs are free, which we love because very few things are free. And so they're free. So you can set one up as a sole proprietor. If you change from being a sole proprietor to an LLC, you have to get a new EIN. And a lot of people don't always realize that because they're tied to the type of entity. But if you do that little S Corp election later, you don't have to change your EIN because you're still the LLC. You're just being taxed differently. And LLC is what I call a transitional entity, right? Because you can technically have a lot of other types. You can have a multi-member LLC, you can have a partnership LLC, you can have an LLC being taxed as an S Corp, or you can have a single member LLC, which is a disregarded entity, which is literally a sole proprietor, but with the protections of an LLC.
Okay, so I want to get into the protections of an LLC and why that's super important to do. Also want to get into talking about the payroll bits and also talking about what's best for people who are international. So we're going to take a super short break and we will be back. Hey, it's Ray. Over the past 5 years, I've been fortunate enough to work with tons of freelancers and self-employed creatives, helping them build healthier, happier, more profitable businesses through private mentoring. And while each person is unique with their own unique business, service, and goals, they all have had one thing in common. They struggle with pricing themselves. And I bet you do too. Pricing is by far the most common obstacle freelancers come up against. It's also the single factor that can make or break your business. Price yourself too low and you're headed for burnout. Price yourself too high and you'll be plagued with imposter syndrome while driving away potentially perfect clients. I want you to soar. That's why I created the Price Yourself Perfectly workshop. Inside, you'll get access to my step-by-step process that I've used with hundreds of freelancers to find the perfect formula for creating a rate sheet that clients love. Stop waffling and lingering in uncertainty and start pricing yourself perfectly. Get lifetime access to Price Yourself Perfectly at chironconsulting.us/pricing. All right, we are back with Katelyn Magnuson, the Freelance CFO, the financial expert, and we're talking about sole proprietorships, LLCs, and S Corps. I'm sure if you're watching the video, you can see the smoke coming out of my ears because my brain is just on overload right now. So LLC seems like the sweet spot for a lot of people until you get to a certain financial threshold. And you mentioned something very important that I want to dive into: protections. What are the protections that come with being an LLC, particularly for creative freelancers?
So with the sole proprietorship, like we talked about, you have very low overhead, right? It's very simple. The barrier to entry is almost nothing. LLCs, depending on what state you live in, like California, Massachusetts, Illinois, they can be a little bit cost prohibitive. Some of those states are up to $500 a year for you to register. It is a business expense, but some people will really balk at that. And I know that that's hefty, especially when you're getting started, but I also want you to think about your personal life and your personal assets. And maybe you have a spouse or a partner or children or a home or a car, all of these things, right? And the goal here would be that you have a great contract set up. But we live in a world where someone can sue you for just about anything. And having an LLC, and there's going to be kind of an asterisk after this, having an LLC separates your personal life from your business life or your professional life. But you have to make sure that you're keeping your business in your business and your personal in your personal. If you don't, it's what's called piercing the corporate veil. And I think a lot of people don't understand, because while it's not legally required to have separate bank accounts as an LLC, if you don't, then if you were to be sued, your personal assets and your business assets can all potentially be up for grabs or be factored into what's going on, with any litigation that could come up financially, because you have not demonstrated that your business is a separate entity from who you are as a person. So I think that doesn't get talked about enough. Having an LLC on its own is not enough. You need to have the LLC plus the good business practices in place. And what a lot of people will do then is like, how am I supposed to pay myself? Right? If you have to keep your business money in there, that doesn't mean you can't pay yourself. That means you're not going to Target and using your business card for personal stuff and using your personal card for business stuff, and then having all of this crossover. It's clean, it's direct. And I recommend just setting up a bank account with whatever bank you bank with personally, most times, because then you can transfer that money instantaneously, which is great.
Yeah, that's exactly what I do. I have Citibank of Texas, not CITI, but CITY. And same thing, like when I want to do an owner's dispersal, that's what it's called when you have an S Corp. It's just an easy transfer. It takes 5 seconds. And my big thing with the bank accounts is anytime I'm working with a new freelancer, I always tell them, set up a new business account the second that you decide you're going to be going into business. Anything you accept through PayPal, any money that you accept through Stripe, Apple Pay, whatever, anything, Venmo, I don't care. It needs to be going into your business account first. That's kind of, for me, that serves multiple purposes. Not only does it start to create this mindset that, oh, I'm running a business, like this is official, like I need to take myself seriously, but also it is that smart business practice, that financial practice of, okay, now I need to pay myself. I am my own employer. And now what you're saying is on top of that, you have the legal protections once you're an LLC. So while I recommend that as soon as someone starts to decide being a freelancer, they should open that bank account, when do you recommend that someone opens up that business bank account? Is that applicable to sole proprietors as well?
I always recommend, so if you're a sole proprietor and you're like, you know what, I'm not sure, or like maybe you live in one of those states where it's cost prohibitive for you right this second to do it, but it's on your like TBD as soon as you can goal. Even if you open a separate personal account, or you have like Capital One has free checking accounts, like there's a lot of them that are personal. And as a sole proprietor, you can kind of let that slide by just having that separate account. But again, same thing. As soon as you have something to sell, or even as soon as you're going to have business expenses, set up that personal account. It's free, it's easy, it's cheap. Added bonus from a completely accounting perspective, you get to the end of the year and you're like, oh my God, my business took off. Cool. Everything for the business has now been run through this account. So you can just pull an export of it. You can see your expenses. You can see your income. Added bonus, you can actually see if you're making money, because what I see happen a lot, and you probably do too, is if you're commingling and you're not pulling everything out of your personal account, you're not going to always know, especially if you have other household income, or you're working a W-2, or you have a spouse that is. If you're paying the bills, you're gonna be like, oh yeah, my business is making money. This is great. But is it really? And is it matching the amount of effort that you're putting in? Because I think sometimes we either underestimate or overestimate either of those.
Yeah.
And so taking 20 minutes to separate it will give you so much clarity over your finances.
Yes, absolutely. Okay, excellent. So I just lost my train of thought. The protections, that's where we were. We were talking about the protections with the LLC. Anything else that we need to know other than, once your business finances are separated from your personal finances, if someone goes crazy and sues you because that logo wasn't just quite right, then you're protected. What other protections are there with an LLC?
So that's really the biggest one that I am aware of, that we really caution against, commingling finances, because a lot of us do have, a house or a car or personal assets that we don't want to be subject to. I'm going to say seizure, and that sounds really harsh, but subject to any judgment that may come through. So with the LLC protection, the goal there is that if you were to be sued, that at the end of the day, the only thing that would close down or that you would be liable for is whatever had gone through that business. And the other concept here, and I'm not a lawyer, would be that if you were, let's say, to go out of business or default on your debts, the goal with the LLC there would be that then the LLC protects you personally, and the LLC could close and fail, but that you would still have whatever your personal income was or whatever your personal assets were without it completely blowing up your life.
Yeah. Yeah. So this is really one of those examples of where, and people who've been around me for a while hear me say this all the time, your business needs to be in service of you, not you being in service of your business. And by thinking of your business as a separate extension with separate finances, separate bank accounts, it really supports protecting the life that you want outside of that business. So, okay, now let's talk about payroll. Now, the self-employment tax is pretty wicked. It's pretty high in almost every state. There's the federal self-employment tax, and then states like California have like an insane self-employment state income tax. With S Corps, you can actually start to run payroll and start saving on that self-employment tax. Do I have that right?
Yes.
Okay.
Well done. Well done. That's a really common, I think, confusion point for a lot of people, because let's say that you have worked, a W-2 or a corporate job for years, and you see taxes taken out of your check. A lot of us are not savvy enough to have paid enough attention to realize that this is for the majority of people, and we're talking federally, that 7.65% is taken out of your check for Medicare, Social Security, et cetera. And you have income taxes on top of that, federal and state if applicable, and then any other local taxes or anything that's levied there, but that really varies depending on where you are. And then your employer pays 7.65%. So they're paying a portion of it. So your cost to them isn't just your salary. It's, PTO, insurance, whatever else comes through, plus payroll taxes. So what happens when you're self-employed and when you are a sole proprietor or a single member LLC, let's say you have $100,000 in profit, because it's a really lovely round number. So you have a tax year, you have $100,000 in profit. And that's, when I say profit, income minus expenses, that does not include what you've paid yourself, because that is not an expense for the business. That's part of the profit. So that 100,000, you're going to owe income taxes on that. Depending on your personal financial situation, probably shakes out to somewhere around 20-ish% in federal income taxes. So that's $20,000. Then you have self-employment taxes or payroll taxes. So beforehand, you paid half, your employer paid half. You are your employer now and your employee. So you pay both halves, which is 15.3% in employment taxes, which is a chunk of change. And so with that, you're now looking at a little over $35,000. Plus local taxes, state taxes, anything else that comes up. The one good thing is you can deduct 50% of your employment taxes as a business expense. So of that 15.3%, you get, or 15,000 in this case, you get to deduct half of that, which would be $7,650. It's going to, in general, save you around $1,000 to $2,000, but you're still out the initial $5,000 outlay. So there is a small deduction. It's not totally disregarded, but it does not completely offset that dollar amount. And that just continues to get larger until you hit, I think it's like $148,000 in profit now, because you continue to pay a portion of that. And so people are like, oh my God, like the first year that you're self-employed and you make more than like $15,000 or $20,000, you kind of want to shit yourself, because you get your tax bill, especially if you haven't been working with someone or you haven't been saving, or maybe you quit your job a little bit early and you're like, oh my God, I did not expect this. Number one, I think every state and the IRS have payment plans. If that ever happens, I think people freak out and they're like, oh my God, I'm going to go to jail. I can't pay my taxes. Like, what happened? And at the end of the day, the government just wants their tax money. Like they're not, if they put you in jail, they're not going to be getting their money from you.
Right.
So like breathe and it's fine. But that's where the S Corp election comes so in handy, because for a lot of the clients that we work with, when you hit between $40,000 and $50,000 in profit, is when it can make sense to start looking at an S Corp election, because that, and this is based on firms, right? So based on our costs, what we charge for additional returns, for payroll processing, for the S Corp election and that setup, that's where it's worth it to us for the hassle for our clients, because they're saving, I think, $3,000 or $4,000 a year on taxes at that point. So the $1,500 or so that they're paying to us makes sense. And I walk them through that because I don't think it makes sense to do it if you're not saving money.
Exactly.
And with that comes payroll setup, comes, instead of just paying yourself as an owner's draw, moving money over, writing yourself a check. There's 17 different ways to pay yourself when you're a sole proprietor or a single member LLC. When you're an S Corp, you can still take those owner's draws or owner's disbursements, and that's fine, but you are required to run payroll and to designate a portion of your profit as payroll. And where it can get a little bit tricky, bless the IRS, is they say that it needs to be a reasonable salary.
Yes.
They don't tell you what the reasonable salary is, but the standard rule of thumb, and this really can vary a little bit, but generally it's 40 to 50% of your business profit, or the going salary for what your job position is, or what it would cost to replace you in your business. And so that can look different as your business evolves, as your profit changes, maybe as you hire a team. Like mine, in proportion to our overall profit, has decreased because replacing myself in my business, if I were to be audited, I could now make a really valid argument that I could replace myself and this is what it would look like. Versus when I was the sole driver of everything coming through, I really stuck tightly to that 40% because I didn't want to have to pay back payroll taxes, penalties, fines, etc., which is what will happen if you pay yourself too little. Because the tax savings comes in on that. If we're using that same $100,000 example, and let's say I pay myself a $40,000 salary, I pay income taxes on all of it. I only pay self-employment taxes on the portion that is my salary. So I'm saving 15.3% on that remaining $60,000 in profit, which I'm not going to do the math right now, but it's a chunk. It's a chunk. And so that's why people look to do it. But I think it can be really confusing because, again, it's just a tax distinction. You can still take that $100,000. That is yours. That is your profit. You still get taxed on it. But you're just simply classifying a portion of it as payroll and a portion of it as owner's draw. And so you'll have a W-2, which is weird when you're self-employed. And you'll have a K-1, and that K-1 reports the remainder of the income that wasn't reported on your salary. And that's just for tax purposes. And it is massive. Like that is honestly, when we have a client come to us, it's new. They're like, oh yeah, I'm making $150,000 a year and I'm a sole proprietor. And I'm like, oh, we have got you. Like you are going to just be so excited because it's a massive tax savings and it's relatively straightforward once it's set up to keep it operating. There are some nuances, there are some accountable plans instead of home office deductions and some other little things that come up, but you can run quarterly payroll, you can run an annual payroll, you can run a monthly payroll. You just need to be recording payroll in the year that you're an S Corp.
Yes. And the thing that I love about payroll, I never thought I would ever say this in my life, but I really love payroll. And if anybody's listening to this and thinking, God, I just don't want to deal with the hassle of payroll, here's the beautiful thing. Like exactly what you just outlined, let's say you're making that 100K profit, you pay the most income taxes on the smallest portion, and then you can still draw from that remaining chunk of money. I have my salary set to a number that is lower than a lot of the people on my team. But I also have automatic owner's dispersals that I don't pay that huge chunk of self-employment income tax on. So my salary is a CEO's salary, but without me having to pay taxes on that full total amount that I'm paying myself. On top of that, when I went the S Corp route, it made everything else that I wanted to do in life so much easier. Buying a house, buying a car, all of those things, when you actually, because our our system in America, and I'm going to be very generalist right now, is so married to the idea of traditional employment. If you can mimic being traditionally employed in your self-employed business, that is so freeing. It's so liberating, because now the banks who want to give you a home loan, they get to see all the paperwork that they want to see without you actually having to have an employer. Whereas you don't have that W-2 when you are running a sole proprietorship or an LLC. Same thing with buying a car. My husband and I bought his Camaro a few years back, and it was so easy. I just whipped out my W-2 that I hadn't had in 15 years. And suddenly I'm a legitimate person earning a legitimate income in the eyes of the traditional world. That is one of the biggest roadblocks that I see for freelancers who are building these businesses for the sake of all the financial freedom that they want. They want the house, they want the land, they want the car, they want all the things. And that's great. But then if you are a sole proprietor, banks will go, no. You accept money through PayPal and Venmo, and that's just too unstable. We don't know where to put your income numbers on our forms, because we have a spot that says W-2 income. And if you don't have a W-2, you're fucked. So this is, in my opinion, one of the greatest benefits, in addition to the tax savings, of getting to that S Corp point.
Absolutely. And it's so frustrating for me because, and I'm sure you feel this way, I have worked many corporate jobs over the years. I have been let go once. I have left a couple of times. Things have happened, businesses have sold, whatever. When that happens, my income goes from what it is to basically nothing or unemployment.
Yeah.
In my business, barring even the pandemic, some clients may shift, some income may change. I have never lost all of my income overnight with a business. And so it bothers me, and I can understand that they're like, well, it's just less stable. It's not actually less stable. My employer could let me go tomorrow.
Yeah.
My business, especially if you set it up, with retainers or recurring income or recurring clients or repeat or anything, all this, passive income and content that goes on is so much more stable. And it's on us, I think, as entrepreneurs, business owners, to game the system where we can. And for me, this is such an easy way at a relatively low income threshold, like 40 to 50,000 in profit, which for a lot of us is 80 to 100,000 in revenue, depending on your individual business type. And when you hit that, you start having savings. You can take a pay stub into the freaking dealership, which is like amazing. It's amazing, because you try to go in and qualify as a self-employed individual, and they're like, no. We need 3 months of bank statements, and we're going to dive into all of your personal financial information, and then we still may not approve you. S Corps are by far, or S Corp elections, I should say, are by far my favorite way for you to be able to get that, because it's relatively low cost. It's relatively low risk, because another question that comes up a lot is, well, I'm making this money this year, but I want to play devil's advocate. What if everything tanks next year and I make $20,000? The only thing that you're out is the added tax filing and the added payroll expenses. We're not talking 30 grand, but we could be talking 30 grand in tax savings.
Yeah.
If you grow.
Exactly.
When you grow.
And on that wonderful note, I want to talk about one last thing before I let you go, which is people who are international. So I have a lot of friends and team members and colleagues who they are abroad. So for example, one gal, she's in Germany, another, he's in Malaysia. They're American citizens, but they're living outside the country. And I want to ask you about this because one of my friends, she lives in Germany. She has her business based as an S Corp in Texas. And so she gets that crazy, the other beauty about Texas is we don't have any state income tax. So she chose the best state for her tax liability, even though she's not actually living there. So what advice would you give, and how does this work for people who are American citizens, but they're living outside the country?
Great question. And we come across this a lot, right, as well with our clients, because everyone wants to be able to travel and have freedom and build their business. And like freedom looks really different for different people. And assuming that A, they're American citizens, and B, that they are earning income from US sources.
Mm-hmm.
What that person did is exactly what we recommend. Not necessarily in Texas, but Texas is a good one. Florida is another really good one. But it depends on wherever you're willing and able to establish residency before you leave, because that's a really big part of it. Is most times you have to establish residency. So, move there, get an address, switch your driver's license, register to vote, make sure, and this is something that we do all the time, make sure you have a registered agent that can receive mail on your behalf, that you have a business address that can receive mail. You don't have to have, like in this day and age, I even have one because I don't want to give my personal address out. I have one that's down in town that handles everything that I need.
Like a
Bonus,
PO box,
they scan
right?
all of my mail.
Like a PO box?
Not even a PO box. It's actually like this one's kind of cool. Some of them are PO boxes that are manned by people. This is actually a physical location that receives all of our mail, scans all of it to us, and we have like an online portal. So I can be traveling or I can be here, and I can access everything that comes to me as a business owner.
Excellent.
Which is wonderful. So you have to have a physical address, not just a PO box, which is why I like this one. If you were to ever be served legal papers, it's a requirement from the IRS that you have to have a physical presence. It's not just a PO box there, but there's tons of registered agents in every state that do just that for business owners. So you establish, residency, whatever that may look like. You get your business set up there, you register to vote, do whatever you need to do, and then you go wherever you want to go. And I'm not going to speak to the international side of it because technically, depending on where you are, how long you stay there, you may potentially trigger a tax liability in various European countries or things of that nature. And a lot of people fly under the radar, I think, especially for shorter terms, or if they're not looking to like buy a house or do things that, establish them as a permanent resident there. And so doing that and setting it up that way allows them to pick and choose, because like maybe you live in Washington or Oregon or California. Please God, don't set one up in California. You can establish residency somewhere else. It's going to save you a ton of money in taxes. And so doing that is great. The only other thing that I wanted to mention about living abroad is what's called an FEIE, and it's the Foreign Earned Income Exclusion. What that is a lovely way of saying is if you are a US citizen and you are not living in the US and you are earning income not from US sources. So let's say you're living in Germany and you're employed by a German employer. You can exclude, I think it was most recently like $102,000. It probably went up for this year, but you can exclude, I think it was $102,000 a year from US income taxes, which is kind of a crock. Because you're paying taxes in the country that you're already living. The US is just saying, yeah, that's cool. We won't double tax you up to 102,000. But what is really nice about that is if you do, like, let's say you have a job making 180,000, US equivalent in Germany, you only have to pay US income taxes on that amount from, 102 to 180, but it resets your tax bracket down. So you're not paying like you were earning 180, you're paying like you were earning 78,000, which is at least a little bit of an added bonus. But there's a lot of details that come with that. You have to be out of the US for certain dates. Like it gets very detailed, and it's not applicable to a ton of people, but is something to know depending on what your financial journey looks like.
Katelyn, you are such a wealth of knowledge. This has been so informative, not just for me in learning, I've been checking the wrong box for so long, but our listeners as well. Thank you so much for being here. Where can people check you out if they want to dive even more into your brain?
The Freelance CFO on Instagram and TikTok, and it's the Freelance CFO. People tend to leave the out. I am also on TikTok and Instagram at Katelyn_Magnuson. And we have our wonderful website, which is the freelancecfo.biz. We have all those S Corp resources. We're putting out a ton of blogs over the summer about them because it's so common. And we have free resources, ultimate business finance checklist, you name it. We're going to do something really cool that I'm not even going to allude to on here. That's going to be on the website that I think will really be a game changer, and it's free. So keep an eye out, sign up for the newsletter on there, and we update everyone with as much value as we can, because I think that's kind of the name of the game there.
Fantastic. Thank you so much for being here and sharing all this info.
Of course. It was wonderful. I love geeking out about this.
And you know your stuff. So if there's someone that you're going to listen to geek out over all of this financial craziness and wrap your head around it, it's Katelyn. So thank you so much. Hey, Ray here again. Thanks for listening. If you liked this episode, please subscribe and rate us in your favorite podcasting platform. Want to be a guest on the show or know someone who has an amazing story of entrepreneurship? Apply on our website at chironconsulting.us/podcast.